It's got some action. You know, for as you said, it's at the lowest volatility, but it's still got reasonable volatility here. We're coming down, and we're at now about 42% implied volatility. Stock was up near the hundreds when it first came out. What's happening now is the stock is becoming more certain, okay? The traders are becoming more comfortable with the stock. They're becoming more comfortable with the levels. It's going to start to trade like a normal stock. A lot of the fear is out of the stock. Now that they've settled in, they had the bad IPO and tanked. Now that all that's out of the way, the stock is starting to trade normally, and the stock actually looks pretty bullish.
So fundamentally speaking, there's a case you're saying to own the stock here. Technically speaking, you're also looking at certain levels as well for Facebook. What's got your eye from a resistance or support standpoint for Facebook right
I
now?
think that 25 is a great level of support. I think we originally pulled back down below 20, held 20, rallied at 25, and we just broke out of a large congestion band. We're now holding 25 very nicely. We've come down a couple times, tried to pop, and we're bouncing right off it. So I think that 25 is a level that I want to own that stock.
So if you want to own that stock at 25, and we're currently just above that where we are right now, what is the options play on it? You're bullish on Facebook, obviously. So how exactly do you make the options trade on this?
I want to sell either they call it cash secured or naked puts, same thing. Okay, I want to sell the 25.50 put that expires in 3 days from now.
The end of this week, the weekly Facebook option.
3 days. I got 3 days. I'm going to collect somewhere between 35 and 40 cents. So on a one contract, I'll collect between $35 and $40. If I'm right, which I think I will be, but if I'm right, if you annualize that out, and you can do that on a weekly basis, you can turn this into a 60% returner on an annual basis of dividend. But
there is a risk here, though, right? I mean, if it does go below that $25 mark, you're going to be put the stock. Someone's going to sell you those shares at $25.
I'm going to own that stock. They're going to sell them to me at $25.50, and I'm going to own them, and I'm going to have to figure out what to do with them then. But what I will do is, if that does happen, I can switch to a covered call strategy, or I can liquidate the position, take my losses, and move on.
Now, there's also another way you can go about doing it. I mean, if you sell puts, that's obviously a very bullish way to go about doing it. There's a more conservative way to take that view as well, using those weekly options, right?
Yes, and the weeklies are great, by the way. In Facebook, they have a tremendous return. What we want to do is we would actually sell a put spread. Okay, still a bullish position. Okay, but what we have to do is we have to reach close to the stock. When I last looked, was trading at $26, $25.98. What I want to do is I want to sell the 26 put and collect that credit. What I'm going to do is underneath it, I'm going to buy the 25 put. I can do that spread for about 30 to 35 cents.
You mean you'll make 35 cents
I'm going to take in credit of 30 to 35 cents. My risk here is a maximum risk of 65 to 70 cents. That's my maximum loss. So the theory works the same. It's like creating my own dividend. The difference is that I have to go closer to the money to sell this and be able to capture a gain, because I have to have certain parameters that I want to make sure that I'm able to get enough gain to make it worth the risk.
But again, 3 days till expiry, so that's also a risk as well there, right? Because there's only 3 days here.
That's the good part.
Weird to happen.
You know, when we're selling options, when we're selling credit spreads, when we're selling puts, the faster expiration gets here, the better off we like it.